On your marks, get set, invest. In the last video, we talked about avoiding those tipsters and doing your own research. We looked at how to find the revenue and profit numbers in a company's financial results, and also how to interpret the CEO's statement. Now, it's time to examine the company you're interested in more closely and find out how it makes its money. Some people call this fundamental analysis, because it's pretty fundamental to know how a company makes its money. First, do they pay out some of their profits to shareholders each year in the form of a dividend? And if so, how big is it? Well, in their full year financial results, Memepot plc, our imaginary company, say that they're paying 30 pence per share. Now we need to find out Memepot's share price. You can go to the website of the stock exchange where Memepot is listed, or just simply type Memepot share price into any of the major internet search engines and it'll probably appear straight away. Or you can type it into your investment platform if you've already got one. So, if the share price is £10, it will usually be displayed as 1,000 pence per share. They usually put everything in pence because, well, it's just easier to keep all the calculations in pence, and the annual dividend is 30 pence per share, so then we divide the dividend amount by the share price to get the percentage dividend, which for Memepot is 3%. Now what this means is in the past year, the company paid its shareholders 3% of the current share price for every share they hold. This is a lot better than typical annual savings rates in a bank over the past decade or so, but of course it's not guaranteed for the future. If the company has an unexpectedly bad year and their profits plunge, the CEO may decide to reduce the dividend for the coming year, or even to scrap it altogether. But on the other hand, if Memepot has a great year, they might even increase the dividend. Now, lots of financial websites will tell you for free what the dividend history of the company is. It's useful to know whether dividends have been going up, down, or staying the same over the years. People with different risk appetites often view dividends in very different ways. To find out how, let's welcome back our wacky little chums, low risk, medium, and high risk. Come in now, don't be shy. Now, here I have a dividend that stays at the same level year after year, hardly ever rising or falling. Do you guys have a problem with that? Now, low-risk investors are often happy to have a nice juicy dividend each year as a source of regular income. Plus, there's always the possibility of the value of the shares going up too. Slow, reliable companies such as utility companies often provide this steady dividend income. For example, water and electricity companies in the UK are highly regulated by the state, so they tend to produce steady revenue, profits, and dividends year after year. You also need to bear in mind that lack of a dividend isn't always a bad thing. Some of the biggest tech companies in the world, including Facebook, Amazon, and Google, have chosen not to pay any dividends so far, instead reinvesting their profits each year to grow the company. But long-term holders of their shares really aren't exactly complaining. From the previous video, we already know that the revenue and profit of our imaginary company Memepot plc, both are up strongly compared to the previous year, and now we have the dividend too. There's one more important thing to consider, whether or not the company can actually afford to pay its bills. Now this might seem like a bit of an odd question, considering we've already established that they're making sizable revenues and profits. But plenty of firms have gone out of business not long after declaring record profits and record revenues because the amount of debt matters. Look for net debt on a company's financial results. It's the number you get when you take how much the company owes minus its available cash. Memepot's net debt is £32 million. That's a lot of debt, but the important thing is to compare it to the profit figure. So we can see that net debt is twice the annual profit figure, which is actually fairly reassuring. It's not generally considered high enough to be in the danger zone. Savvy investors tend to start getting worried when debt is 3 or more times the profit figure, because it suggests there isn't much margin for error, and if anything started going wrong for the company, it might find itself in a position where it just can't pay its debts and has to shut down. But Memepot looks like it's in good shape. Fast-growing revenues, tick. Strong rising profits, tick. A fairly decent dividend yield, tick. And manageable debts, tick. Because Memepot is a fast-growing tech startup company with an uncertain future, It tends to have a volatile share price, which makes it a high-risk investment. So let's welcome back our excitable little friend, the high-risk investor, who's decided it's time to buy meme pot shares. No, high risk, no! Calm yourself, you cheeky little scallywag. It's not yet time, because even though we know meme pot's a healthy-looking tech stock, maybe there are even more attractive shares out there to buy instead. You need to consider the opportunity cost of owning meme pot shares. Don't worry, all shall become clear. Now, you only have a limited amount of money to invest, right? So let's say you buy meme pot shares and they go up by 10% a year. That's good. But what if its competitor is rising at 20% per year? Yes, high risk. You're not so bouncy now, are you? Because the opportunity cost of owning meme pot shares is the amount of money that you've missed out on by not owning Pickpot shares. So what exactly is Pickpot PLC then? Well, imaginary company Pickpot PLC will take all your favourite picks and store them for you in a virtual pot. Genius! Sort of. Hang on, I'm getting a touch of deja vu here. Can we rewind to episode 1? I thought it seemed familiar. So we've got two companies with basically the same business idea. So how on earth are we supposed to choose between them? We don't necessarily want the biggest company or even the one with the biggest profits. We want the one whose shares are going to make us the most money. So first of all, let's work out which company looks nice and cheap, offering us good value. We can compare them by calculating what's called the price-earnings ratio. Here are the share prices of each company. As you can see, MemePot's share price is 5 times larger. So does that mean that Pickpot's shares are much cheaper? Not at all. The price means nothing until you combine it with other meaningful figures like profits or dividends. So what we need is the profit per share of each of these companies, usually known as the earnings per share figure. Then we can divide the share price by the earnings per share to get a crucial number called the price-earnings ratio. MemePot has a much lower PE ratio, which, all else being equal, means its shares look like better value than Pickpot's. It means that the shares look cheap compared to the company's profits per share. Now, it's important to note that PE ratios aren't great when you're comparing two firms in different industry sectors, because these ratios vary wildly depending on the kind of industry. But for the tech industry, which includes MemePot and Pickpot, 5 and 10 are both pretty low numbers. Companies that are growing fast, as tech companies often are, usually have much higher price-earnings ratios. For example, Amazon typically has a PE ratio higher than 50. Because the earnings growth rate of a company is so important in determining whether a company is good value or not, on many financial websites, like the main stock exchange websites, you can usually find another useful figure called the PEG ratio. What they do is they take the PE ratio and then divide it by the company's earnings growth rate. Basically, the lower the PEG ratio, the better value the shares are thought to be. Now in this case, MemePot has much better value shares than Pickpot. So it's a reasonable assumption that its share price has more room to grow faster in the future. Now, of course, it doesn't always work out that way in real life, but hey, that's what risk-taking is all about. The future is ultimately unknowable. So there's no such thing as a sure thing, whatever the tipsters may tell you. The best an investor can do is take an educated decision, and then you diversify across different investments with a whole raft of educated decisions, and hopefully at least some of those will turn out to be big winners. That's how it's done. Now, I've thrown a lot of figures and ratios at you so far, but have you got enough mental bandwidth left for one more? Of course you have. The PEG ratio is very important for so-called growth investors, people who want to invest in companies that are really going places fast. But what about people who are after an absolute bargain? A company that may not be growing its revenues and profits fast, but has been generally ignored and overlooked by investors. So its share price may be languishing at a juicy low price, just waiting to be discovered by a canny value investor. These investors are on the hunt for low price-earnings ratios, certainly, but there's another metric that can help them too, the price-book ratio. This ratio compares the price of the shares to the value of the company's possessions, its assets. But first, you have to deduct the value of its liabilities, the money that it owes to others. Once you've done that, you're left with all the stuff that the company owns, factories, equipment, inventory, anything that's worth money. Sometimes a company has a price-book ratio that's lower than 1, and that means that all of its shares added together are actually worth less than the company's possessions. So in theory, you could buy all those shares and then break up the company and sell its parts for more money than you paid for those shares in the first place. But, assuming you're not a gazillionaire like legendary investor Warren Buffett, what you can do instead is buy some shares in the undervalued company and wait for other investors to realize that they're too cheap and to start buying them too, which pushes the market price upward. Or maybe you'll be lucky and some clever Buffett type will buy up the entire company, which will mean them offering you money for your shares, hopefully a lot more money than you paid for them in the first place. So there you have it. You now have a bulging toolkit of valuation techniques so you can carry out what we call fundamental analysis of a company. You've learned about revenues, profits, dividends, debt, and also about valuation ratios, the price-earnings ratio, the PEG ratio, and the price-to-book ratio. And remember, you can usually find these figures on the stock exchange websites for the particular shares you're interested in, and on any number of independent financial websites too. And remember, aside from all the figures, the most important thing is always to understand what the company actually does and how it makes its money. That way, you can get a better idea of whether it has a bright future or not. Now, in the next video, more on funds, those useful investments that spread your money across entire sectors, countries, or even across the entire world.